Good morning. It's Friday, the 27th of May. Jeff Christian from CPM Group. I'm back in New York. I wanted to talk today about economic volatility in the Fed. And in preparing to talk about that, I realized that in August of last year, I did a video called The Fed and Economic Volatility. And it's pretty much the same subject. People inaccurately claiming that the Fed has increased economic volatility and blaming the Fed for a lot of things that happen in the world and in society based on either an incomplete understanding of the facts or a strange interpretation that's probably rooted more in their personalities than in reality. I was going to talk a little bit also about what Thomas Jefferson actually said about banks. That's another often quoted quote, cited quote that actually is gruesomely twisted and inaccurate by people for their own purposes. But in order to keep videos shorter, I'm not going to talk about that today. That's perfect literary en passant. I might have chance and opportunity to talk about it in the future, but not today. So it's going to be a little bit more brief. So I wanted to talk about economic volatility in the Fed. And again, it's a subject that's coming around again. Various people are saying that the Fed is the source of all evil and the problem with economic volatility and not a solution. And this chart goes back to 1815. It shows real GDP rising and falling since then. And you can see a moderation of the economic volatility really since 1947. The Fed was created in 1913. The legislation was passed in 1913. The Fed was created in 1914. And you went through the World War I, the Roaring 20s, the Great Depression, and World War II. And then after 4 cataclysmic decades, which are very important to understand and pay attention to, because those 4 cataclysmic decades were not caused by the Fed or other central banks, despite what some people say, but they contributed massively to economic volatility. And they also contributed to the economic attitudes and political and social attitudes that came out of 40 years of that kind of economic and political and social and military volatility. But after 1947, you saw a continual reduction in the volatility of the US real GDP. And you have a similar pattern, slightly different because you had the 1970s in there with US inflation. And yes, we can see that we've seen the biggest recession since 1947 in 2020, radically different, induced by fiscal government, the federal government, and governments around the world to fight the pandemic. So different from others. But we have seen some increased volatility since 2006 or so. But the reality is that since the Fed has been created, you have less volatility. In order to understand that, I mean, there are people who rail against the idea of a central bank or a national system of banks. And that's really what the Fed is. The Fed is a system of nationally chartered banks that are regulated by the federal government. And that's very important because if you want to understand where the Fed came from and why the Fed was created and why we had this massive volatility in the 1870s, 80s, 90s, and 1907, if you want to understand the volatility that we had in the economy and the constant bank runs that we had prior to the creation of the Fed and the national banking system, you have to understand why. And the reality is that prior to the creation of the Fed, most banks in the United States were state chartered banks. And state chartered banks were allowed to lend out money on a fractional reserve currency, which is actually not an epithet or an expletive statement. It's a reality that actually goes back thousands of years. The banks are allowed to take in deposits and lend out more than they have on their balance sheet, predicated on the view that not everybody's going to want their money at the same time. And by lending that money out, you can earn interest for yourself, the bank, and for your clients, the term deposit holders, if you have a bank CD. And B, you can help the economy grow. The problem is regulation. And in the early days of the United States, there were a lot of people who had state chartered banks, knowing full well that the states didn't even have, in many cases, auditors, much less auditors that came around and audited the banks to make sure they had the gold and silver in their vault to support the amount of banknotes that they had printed and issued. So bankers had a free hand to do whatever they wanted. And I've shown you books in the past, The Nation of Counterfeiters, which is a history of banking in the 19th century in the United States. And the counterfeiters were the banks. You had state chartered banks that ran amok, and people would see that they had run amok, and they would go to withdraw their gold and silver, and the banks would collapse. And you had bank runs and bank failures and all sorts of problems throughout the 19th century. Right. In addition to that, you had a problem with the fact that the state chartered banks were issuing their own banknotes. So if you were going to move from Ohio to Kansas as a farmsteader, you would take your banknotes from the first bank, state bank of Canton, Ohio, to Kansas, and somebody would say, "What the heck is this?" So you would want your money in pieces of 8, Spanish silver, silver coins, and gold coins to make that move. So having a nationally chartered bank helped homogenize the economy in the nation. It helped promote economic activity and migration, and it also provided some greater regulation than the state banks. We had the first Bank of the United States in 1791, and it ran until 1811. It had, I think, a 20-year charter, and things actually went pretty well. And that bank, starting in 1791, by the way, part of its deal was to get repaid to the federal government the money that they had lent to the states to prosecute the War for Independence, the Continentals. And if you recall, in the Constitution, there is a clause that says the states may only use gold and silver to repay their debt. Now, a lot of people have misconstrued that to say, oh, only gold and silver are money in the United States. Wrong. The Constitution and the drafters of the Constitution were extremely careful in their words. And they said the states may only repay their debt in gold and silver. This is a federal constitution, and it was designed to bring gold and silver into the federal treasury in payment for the money that the nascent government had created during the War for Independence. So that bank actually went pretty well. But there were a lot of state bankers who didn't like the idea of an overarching national bank that could look in on what they were doing and say, hey, you're printing more money than you have gold and silver to back. You ought not to be doing that. So there was a lot of state bankers who paid a lot of politicians to make sure that in 1811, the first bank in the United States did not have its charter renewed. We went into a deep and prolonged recession after that, characterized by massive counterfeiting by state banks, bank runs, bank closures. Banking interests basically executed the national banking system in order to pillage the country. And they made sure that their congressmen were well paid for allowing that. It was so bad that by 1817, we started the second bank of the United States. And then this bloodlust guy, Andy Jackson, came along and said, states' rights, you know. And he got rid of the second bank of the United States and plunged us into a very deep and prolonged recession. characterized by bank runs, massive counterfeiting, and a lot of economic problems. And this continued. Then again, as I said earlier, 1870 and 1890s, three major depressions, periods of very high inflation, maybe not hyperinflation as economists would define it, but very, very high. You know, again, massive fraud by state chartered banks. It just went on and on. Three full-fledged depressions in 30 years, all of which I believe, we're looking at chart again in a second, were probably bigger in depth than the Great Depression of the 1930s. They all came to a head in 1907 when a state chartered bank issued more money than it had in reserves and went bust. The president was off hunting in Latin America. The Treasury didn't have a telephone at the time. The Treasury was oblivious to this. JP Morgan, the man, actually wound up putting in like 25 or $50 million of his own money to shore up these various banks and stanched the bleeding of the bank panic of 1907. But we went into a series of recessions. And from 1907 till 1914, in the 90 months ensuing, 60 of them were in recession. So by 1913, JP Morgan and other bankers were saying, look, we have to have a nationally chartered bank. We have to have a network of nationally chartered banks that we audit, that we make sure are paying attention. We will have a reserve requirement, and we will have annual, if not more frequent, audits of nationally chartered banks to make sure that the banks have their the reserves they're required to have in there to stave off future bank panics. Because the next time it happens, I don't want to put up my own money to bail out the nation. Now, there were these people who said, oh my God, JP Morgan, you know, these guys, JP Morgan and the other guys in New York, they engineered all of this to take over these banks. And there was a commission in Congress, the Pujo Commission. And there's a great quote from one of JP Morgan's people testifying before the Pujo Commission saying, sir, understand this. We do not like these men. On our own, we would never have worked with them. But for the sake of the nation and the nation's economy and the nation's financial system, we have bailed them out. Didn't really say it quite that way, but that's the gist of it. And you can see tremendous economic volatility. I misspec. The recession, the depressions of the 1870s, 80s, and 90s were not as deep as the Great Recession. And I know that I have to be accurate because there'll be some person out there who will say, oh, Jeff Christian said, ho, ho, ho. No, but we had major recessions and depressions. We had bank runs, we had hyperinflation. And after the Fed was created and it started to try to put itself together, we hit World War I and the Roaring 20s, a lot like the last 20 years, maybe. The Great Depression, World War II, then the recession of 1947. All of that made the Fed's job more difficult. All of it was not monetary policy, but it affected monetary policy. But since 1947, we have seen a steady reduction in the volatility of the US economy. And part of that reason is the creation and existence of a national bank system, which is overseen by the Federal Reserve Board. I'll end with two anecdotes. 2019, I did a 3-hour conversation with Alan Greenspan for a Hong Kong Chinese client of ours, interview with Alan that was far-reaching about a variety of topics. And after that, we had lunch. And I said, you know, Alan, you know, you're a big gold bug kind of guy. In fact, we offered to pay him in gold. You like gold. But if you look at the gold standard back then, You saw these massive fluctuation, big recession, depression, followed by hyperinflation, followed by depression, followed by hyperinflation, over and over again. And how can you reconcile that with your view that a gold standard makes sense? And he said, of course we had depressions and hyperinflation. We were in the species currency, i.e. we used gold and to some extent silver in our currencies. And the existence, the very existence of a gold-backed currency system is what led to those depressions and hyperinflation, in his view. Now, earlier, probably the late 80s, I think early 90s, I was in a meeting with Ron Paul, who also says that the Fed is the source of all volatility in the US economy. And this chart didn't go out till here, it only went out to the 80s. And I had this chart with me along with some other charts. I said, Congressman Paul, how do you reconcile your statement that the Fed has increased economic volatility with the data on US real GDP being less volatile since the 1940s? He walked out of the room. He wouldn't answer the question. I raised the question to him several more times privately by sending him letters saying, hey, could you address this? And publicly in places where he and I were both appearing. He has always refused to answer that question. And that's why I like Alan Greenspan. All right, that's all for today. We're seeing gold prices having broken out of a little channel. They've moved a little bit higher up to about 1860 something, 1865 as we speak. Silver has broken back above $22. It got up to about $22.40, $22.45. We think that the prices could go a little bit higher over the next week or so, but we're looking down the road at the Fed's next meeting in the middle of June, the probability of higher interest rates, the further reduction in the war premium, and probably a lowering of inflation expectations over the next few months. So we're not particularly thrilled about the price outlook for gold and silver for the rest of this year. We do think there's a little bit of scope for stronger prices now, the next week or so. But for the rest of this year, it's, as we've said, we thought it would be, maybe a little bit weaker or lower, but sort of moving sideways. And then again, at some point, we do think that there's going to be a lot of political, economic, fiscal, and other issues and financial issues that will cause investors to increase their demand for gold and silver, driving the prices back up, probably to new record highs. But that's sometime in the future. Some people think it's already starting. Some people think it will occur in 2023. Our best bet is 2024 to 2026. Because if the world has taught us anything, the center does hold. Things don't necessarily fall apart. And we keep going. It's not a movie, it's not a book. You can't talk about the end of history or the end of banking as we know it. It's life, and things go on. Have a good weekend. Talk to you next week.